There's actually the lowest number of investors in the market right now.
In the last 20 years.
Yeah, it's crazy. So there's 52% owner occupiers. There's about 22% first home buyers, and the remaining around 24% being investors. So really low levels there. We are back with another update on the market throughout November with some information today from CBA, CoreLogic, and as always, Phil Anderson, Catherine Cashmore, and Fred Harrison. So really exciting news this month. It just feels as though we've been bombarded with a whole bunch of emails every single day with some more positive news, eh?
I've been sleeping a lot better because some of the big dogs and the big banks and the big investors like Phil and Fred have been putting out some really positive stuff that I just haven't been hearing in the last year and a half.
Seriously. So why don't we kick it off with a bit of an update on what we've heard from CBA.
For anyone who doesn't subscribe to the CBA updates, go and get on them. They are phenomenal. So in terms of the latest update we got from CBA, and thanks again, Ray, for sending those through to us, the economic recovery has been much stronger than expected, to the point where they've actually updated their thoughts on how much GDP next year and the year after will increase. And if you had have looked at them at the start of the year, they were looking really bad for this year, really bad for the next few years. But they're actually now expecting a 4.2% increase in GDP in 2021 and a 3.8% increase in GDP in 2022. So that's positive, back in green territory, and obviously as a result of some of the incredible initiatives the Australian government's put in place throughout this virus. The big piece of news from my perspective is unemployment rates. Now, I honestly thought at parts of the virus, particularly between March and sort of August, the numbers were being massively cooked by the ABS and Australian government. And I thought we might have been sitting at as much as 15 to 20% unemployment. But what's promising from CBA is they expect by the end of 2022, those unemployment rates to be back at 5%, which is a really nice sweet spot to be in, and good quality employment too, with a good percentage of full-time work as well. They've also gone on to note that the threat of the coronavirus in Australia, obviously because of the incredible action that we've taken as Australians and as governments and as medical staff, has been dramatically reduced. And you can see that compared to some of the other countries around the world that are just struggling so hard with it still at the moment because they just won't take those heavy measures we've had to take here. What I love, because anyone that understands investing understands there's only one real thing that drives prices up and down, and that is consumer confidence.
Yeah.
Now, it could potentially be the worst market we've been in the last 10 years this year, but for some reason, the Aussie loves an underdog, and we're now at a point where confidence is at a 7-year high.
That's amazing.
Now, confidence drives Bitcoin up, as you've seen at $21,000 this week.
I've just got to say something there. We're in a chat with all of our mates on the Sunny Coast. It's like a surf group chat, and all they're talking about right now is Bitcoin, and it's just so funny to see.
They love the bandwagon, those boys. They're the top buyers. So whenever those boys are talking about buying stuff, you don't. But it's also, a positive thing. Like, it also drives stocks up. It drives money into businesses. It also drives money into the real estate market, like Simon will explain in a moment. Now, what's crazy is that savings have continued to grow this year. Now, the beautiful thing about fear, being humans, is we go back into the hole and we save money and we squirrel away. And I think it's a beautiful thing about the Australian psyche. Now, we've been able to save, they estimate, an extra $100 billion in household savings on top of what we had last year, which is up almost 15%. Now, talking to my accountant this week and last week, he reckons that 15% is going to come crashing straight back into the economy in terms of stocks, houses, experiences, Australian travel over the next 12 months. And that would, rebalance back to a normal position. But right now, Australians are sitting on way more cash probably per household than most Australian households need. Myself and Simon have saved good money this year. We've invested that money this year. And I know so many of you have done the same thing. Now, CBA went on to say that the housing market is no longer a source of risk. They were concerned primarily about two things. One of them being the construction sector taking a massive dive, which thankfully the Australian government has been able to repurpose money into infrastructure and construction. And now we're actually about to go into a construction boom, which might feel weird, but if you follow Phil's work, he says the next stage of the cycle is a massive spike in infrastructure and construction, which pulls the economy back into the green territory.
Just think about what you're experiencing right now as well. When you talk to your friends, your family, colleagues, anybody, like everybody is super busy at the moment, especially people in the construction game. You know, a few of our friends work in construction, a few of our family members work in construction as well. And it's just absolutely booming at the moment.
It's booming.
So this is the sort of positive consumer sentiment and the stuff that is coming through in these CBA reports as well.
You know, we've got builders that we know sending us emails saying we cannot get a new client started for the rest of the year. My brother-in-law was over here. He's just started his own building company in Brisbane. He got himself on High Pages the other day. He's getting 25 leads a day for major work. Like, it is not just happening here. I talked to my mate Macca in Sydney who runs a construction company down there, and he said he's never had more on than he's got at the moment, which is just super interesting. So house prices have started to rise again in almost all of the capital cities in the last month, except for Melbourne. They've actually grown in value. And in terms of the last year, again, like across the board, Australia's capital cities have fared very well. Now, if you look back to our content in January, February, March, even our content back in 2018 and 19, when we were telling you that 2020 would be a serious year based on our advice from Phil Anderson and Fred Harrison, as well as Ray Dalio, what we were saying was that generally what happens during this particular stage of the mid-cycle slowdown is the stock market gets an absolute beating for between 9 and 18 months. Generally, stock prices decline on average by about 40+%. And property prices around the world either sit flat, slightly go up, or might retract by as much as 10%, which is the experience we've seen in Australia. You know, I don't know anything about stocks, but I know from a property perspective, it's fared much better. And in some areas like Byron Bay, houses have literally gone up by 800K in the last 9 months.
Yeah, it's some areas on the Sunshine Coast here where we're recording right now, and also up where our mum lives. Insane 3 month growth, insane.
Now, what we're about to move into, and CBA talked about this in the last update Simon and I shared, is a domestic tourism boom. What I realized is that Australians normally spend about $35 to $40 billion a year in traveling overseas, but we also spend around about $35 billion a year on traveling inside Australia. So now that we can't travel overseas, and that might be for as long as the next 2 to 3 years, you can already see it in the advertising campaigns from the Australian government, the Queensland government, the Northern Territory, and New South Wales. Like, I'm loving the ads, by the way.
Oh, they're so good. They do the best ads.
Spend money in Australia, and I love seeing that positive stuff. Like, I love seeing the Goldie, I love seeing Ezrock, I love seeing that sort of stuff in my space rather than the fear that we've received all year. And you know, all of that money that has been stored, that some of it's been spent on luxury cars apparently, is going to start being spent on domestic travel. Now, in terms of my own Airbnb on the sunny coast that I set up last year, it is fully booked for December, January, February, March, and April are now half booked. And you know, I've never seen it look like that before, but it's because, you know, why wouldn't you want to come up here after being in Melbourne and Sydney lockdown for the last year?
No doubt about it. Now we've had the announcement from the government that the borders are going to open from the 1st of December as well. It's just going to give everybody that extra tick of approval that they need to go ahead and book it.
You know, this year I went to Darwin, Casuarina, Kingscliff, Byron Bay, went to the Gold Coast a couple of times.
Palm Cove.
Palm Cove up in like
North Queensland.
Now, if Simon and I had the chance, like, we probably would have gone to Bali or Papua New Guinea, and we also would have gone to the States, but instead we went and checked out Australia, and it's freaking beautiful. Like, I don't really want to go overseas except for surf trips anymore.
I know. I never really had the intention for Australia until I started doing it properly. Like, I was always jetting overseas, but 100%. Like my year is just going to be doing awesome, fun stuff around this beautiful, beautiful country that we live in. And this is exactly what CBA is saying. So some really cool updates. We get those updates from CBA probably about once a week.
Love them.
And there's just so much gold in there. And it's quite similar with CoreLogic. So let's talk a little bit about some of the updates that we've been getting there over the last month. So basically what they've said is that national housing finance is on the increase, which is really positive news. There is a bit of a correlation between housing finance and price growth that actually came out from Catherine Cashmore as well. I didn't get a real chance to review that one. Do you want to explain that Catherine Cashmore one in a bit more detail?
Yeah, like Ryan over there at On Property did a really good update on the article I sent through to him, and thank you, Catherine, for all of the great work you do. But basically, she overlaid the number of new mortgages, or the number of mortgages in Australia being written versus the average annual capital gains across Australia over the same period of time. And what it looks like is, you know, the number of new mortgages look like that. And then what was crazy since 2003 when the data was started, the capital gains almost automatically follow that within a short period of lag. Now, why that's important is the number of new mortgages has just gone up by 30% in Brisbane and 35% in Perth. That is really important to know as an investor in terms of where to place your money, because if the last 20 years are any guide to go by, or 17 years, generally we'll see the pattern follow that. And it makes sense. If more people are buying, there's less stock on market at the moment. In fact, half the stock there was last year. It makes sense that demand is outstripping supply in those areas, which we'll talk about more in a moment.
And hopefully it comes through. Now, the next thing that they've been harping on about is the number of owner-occupiers and first home buyers in the market at the moment. So these guys are really driving it. There's actually the lowest number of investors in the market right now.
In the last 20 years.
Yeah, it's crazy. So there's 52% owner-occupiers. There's about 22% first home buyers, and the remaining around 24% being investors. So really low levels there. Obviously, the owner-occupiers and the first home buyers taking advantage of the government grants that are available, and obviously taking advantage of the extra savings that they've got in the bank as well to either upgrade or whatever they might be doing. You know, I know that we've been super active in our personal portfolios. We were planning on having a down year this year, and that didn't end up happening.
I should have gone overseas. It would have been way cheaper.
And then it was really insane to kind of unpack the 12-month performance. Just before this video, we opened up the indices for Australia to kind of look at what's been happening in the capital cities, because if you've just been watching the major media outlets, then you're just thinking that, you know, it's been horrible. But
if I was talking like and listening to the mainstream media, I would have thought Sydney and Melbourne had washed off 15% this year. But the data is insanely different.
Yeah, so I'm just going to go through. Sydney's up 7.1% over the last 12 months to the 31st of October. Brisbane's up 4.3%, which is amazing. And this looking at the whole markets as well. Adelaide was up 4.2 as well. Canberra, really strong performance at about 7.3%. Hobart at 6.9, and Melbourne sort of just behind, but still a little bit positive at 0.3% up over the last 12 months. So clearly the data is telling us something very different and looks really interesting. And, you know, even the last month, we've seen increases in just about every single capital city as well.
Now, one of the biggest lessons that I've learned through this experience of not just having Phil and Fred's history to go off, but also what Ray Dalio said, like, you know, when a guy like Warren Buffett and Ray Dalio come out publicly on, you know, the media in America last June and say that they've taken every piece of cash that they have out of the marketplace and have stored it in a vault to place it back into the marketplace because there's a coming issue. And those guys are both at a stage of their careers where they are publicly trying to help people. Like they're not coming out there and saying that so that people go rushing into the market and do the opposite, which a lot of people did for the 6 months after that, and prices did spike a bit, but they're saying that to protect the average person that they care so much about. So I've learned that the difference between mid-cycle and end of cycle is in mid-cycle, governments like the Australian and international governments are more than happy to go into massive, massive debt to do absolutely anything, any amount of money they will get into debt-wise and chuck on the issue. And then in 7 or 8 years' time, a lot of that debt will be paid back. There'll be, some inflation which will reduce the values of their debt, but they will still be in a big debt position. And next time this comes through the market, whatever the event looks like at that time, they won't be able to just jump on the fire and cover it up like they have this time. And so there will be a bleed. They won't be able to step in and help all of the banks. The Australian banks are in a beautiful position at the moment, according to CoreLogic, according to the banks themselves, but it would be nice to really see what their books look like. But a friend of mine works at the very top of one of those banks, and I was away with her in Darwin a couple of weeks ago, and she was sort of saying the amount of cash held on reserve with some of these Australian banks at the moment as a result of the Royal Banking Commission is unheard of. Incredible amounts of money sitting there waiting for a green light from the Australian government to start releasing it back into the economy. And that makes me feel good that we have a government and a banking system which in some ways really gives a shit. And I know everyone's got a different opinion and we might get some hate on the comments about that, but you look at the state of some of the European countries and banks as well as the American ones, and I am super grateful to be an Aussie right now.
There's a reason that we always end up in the top 3 countries in the world, right? We do have a good system set up and it does help, but sometimes it doesn't feel like that as well.
I was talking to my accountant about this the other day, and we were talking about, how I said to him, well, look, by 2024, 25, we're going to be in about 800 billion in debt. And he said, Ben, almost all of this money the government's let out this year, and I wasn't thinking like this, will come back. He's like, think about the JobKeeper money that your business has been on. They gave you that money, then you went and employed 4 people. You're paying tax, super, insurances on all of those people's wages. He said you're automatically going to pay GST back on that money. You're automatically also going to pay 30 cents business tax in the dollar back to them. I'm like, they're going to recoup almost all of that money. It's like every single public outlay that they're making at the moment goes into jobs. Every one of those businesses pays money back. It's like at least 50% of the money that they've laid out will come back in the next 3 to 4 years. And I'd never thought about it like this. And this is why it's good to have incredibly good people that think differently, that are smarter than you, constantly around you, giving you different ideas as well.
Exactly.
So what I loved and what gave me great comfort was Phil Anderson sent out an email to his subscribers and anyone that's not subscribed to his newsletter.
Property share market economics.
Insanely valuable tool, life-changing for me in the last 4 years. He basically dropped one little line which made me sleep so good, which was, we are now entering the second half of the real estate cycle. Now, the media is going to tell you that things are really bad for the next year and a half. But the next year and a half, as he said, or the next year will be a once in a 10-year buying opportunity for smart investors. Now, take that with you will, or what you will from that. I'm not saying go out there and rush into certain things that are already overvalued, that are already cooked, that are already getting massive speculation. But look at some of these markets like Perth or Brisbane or Adelaide that, according to CoreLogic, are cheaper than they were 10 years ago, and you might just find some great value there.
No doubt about it. I know I've personally changed my strategy. You've sort of shifted a little bit after hearing this news, because Phil was basically saying, go out there and buy assets now.
And I literally went and did that week. So, the other thing that Phil said was just commenting on some of Fred Harrison's work. So in Fred's book, Boom Bust, which he released in 2005, telling the entire world that there was the 2007 recession coming, the GFC. That book looked at 400 years of booms and busts. He went back and did all of that research for you. But what Fred said, which Phil commented on, was there hasn't been a single event in the past where we've reached a boom and then a bust without the landlords or the people that own the lands, the property owners like Simon and I, being in a financial position where the rent doesn't cover the cost of the loan. Now, 2 things are going on in Australia right now. Rents are increasing in some areas insanely quickly. Like one of my properties, the rent's literally jumped by $200 a week. Another one, it's jumped by $100 a week.
I'm increasing the rent on both of my properties at the end of their leases as well.
Yeah, my Airbnb will literally do an extra $20,000 this year on what it would have done last year. Like rents are going nuts. My average nightly rate for holiday accommodation is going up because there's 20 million Aussies and 2 million of them want to travel this year or more. You know, this is important stuff to note, that on one hand, rents are going up. On the other hand, interest rates have gone down. Now, I've got interest-only loans with properties that I own in a trust with offset accounts of rates of 2.85% right now. That is insane. Like, I've got clients with rates at 1.95% principal and interest for their own home.
Yeah, I'm just about to refinance my entire portfolio, and the combined interest rate's going to come right down. I'm going to interest only, and it's looking like it's going to be somewhere between 3 and 3.3%.
Insane rates. And like, if you were to like squeeze, because what you do, like I got those same rates, and then what I did is when I was across, I said to my broker, I want a further reduction based on my volume lending. So I've gone to one bank now as opposed to being split across. And then when we get closer to the top of cycle, I'll strategically pull all of those properties to different major banks to reduce my risk across my portfolio. But it's super interesting, this stuff at the moment. And it's an important thing. Like, there has never been a bust in the past in history of America, Australia, or Europe, according to Phil and Fred's work, where people like myself and yourself were still able to comfortably carry the cash flow on their investments. Now, Phil went on to say that we are not even close to that point. In fact, a lot of people with good quality properties are now not just covering the interest, but their expenses on the loan. In terms of the 100% of people that got freaked out about this at the start of the year, we're looking at only maybe 15% of those people in hospitality, in retail and in tourism that have been really heavily affected, and then a couple of service-based industries as well. So it's time to sort of start to look up, start to get the data like we are, and start to feel a little bit differently. Now, what have you been noticing in the market, man? Because we are both in it every single day. Like, what are we noticing? What are we feeling?
It's ridiculous. Like, I've been working in the property game for the last 4 years now, and there's been short little spikes in certain little pockets of the market where we've experienced things like this, but it seems like it's the market as a whole, because we're looking in South Brisbane, we're looking in Brisbane City, we're looking in the north of Brisbane, we're looking on the Sunshine Coast, and it's everywhere. One of the big things that we're seeing is an increase in the DSR score. So an increase in the demand to supply ratio, which means basically it's a hot market. We're seeing a real decline in the vacancy rates as well. So a lot of the rental stock is starting to get soaked up. There's parts of the Sunshine Coast right now where the vacancy rates are at literally 0%. There is 0 properties vacant in the areas. So this is really driving up those rents that we've talked about as well. Good properties are selling like that,
2 hours, 1 hour online. That's the benefit of getting pre-market and off-market stuff right now and having long-term relationships.
Yeah, we're seeing slight increases in property prices, and it's going to be really interesting to see the sort of 3 monthly performance once we redo our suburb data in January to actually see what has happened in some of these areas, because we're feeling it big time. Gone are the days of buying a property below market value. It just does not exist anymore in a quality area. And in certain blue chip owner occupied suburbs, we're seeing people pay $20, $30, $40, up to $60,000 over the asking price just to get it under contract.
Now, this is interesting because there's two things happening here. There's one, like what the government's trying to do is create upward pressure at the bottom of the market. And Ray Dalio talks about this in in Big Debt Crisis book. It is one of the most common things governments do, and that's they light a fire at the bottom of the market. The first home builders grant, the mum and dad building grant, the first home home buyers grants as well around Australia. And what that does is it drives a lot of people into the bottom of the market in the 200 to under 500K range. Because there's more demand in that range, prices in that range jump a little. And then the people in that range that are moving on to their second property sell, the first time buyers move in, the second timers upgrade. Then because in that second tier areas, like 15 to 20Ks from a city or a couple of suburbs back from the beach, prices jump there. They go, well, maybe it's the time to sell here and go for what we want. And then it's a fear, like panic starts washing through the market. And
FOMO.
We saw this in Sydney and Melbourne between 2014 and 17. The thing about this is you've got to put everything in perspective. Now, if you're in Sydney and Melbourne now that are already up by 80% on where they were 10 years ago, then, we may see this wash through the market, but there's going to be, without the international investors, a price ceiling on what locals can afford, because unless Sydney and Melbourne are international markets, the locals, based on their incomes, cannot afford for prices to grow by another 100% in the next 10 years. But you know, I guarantee within 2 years, the international investors will all be back.
Oh, yeah,
to get the Australian economy going again, and then to blow the prices up in Sydney and Melbourne.
Yeah, the government will open the floodgates. People will come on into Australia, snatch up a whole bunch of the properties. It'll put more pressure on there. More demand, less supply, increase property prices.
Yeah, but in other markets, when I'm saying, and Simon's saying, that we're noticing the market's warm, there's the first timers, second timers, there's the interstate investors like you that will be coming up here. And then there's also the people coming out of Melbourne in absolute droves right now. Now, the Queensland government was smart enough or silly enough to say that we'll let you, the 50,000 people from 25,000, 20,000 households come across in the next 6 months. But you need to either own a home or you need a rental in your name. Now, that was really smart by the Queensland government to secure things from a virus perspective in terms of knowing where people were moving. But it was a crazy thing. On top of insanely low vacancy rates, they are now putting insane pressure on the rental market in Queensland. And it's had the reverse effect of what I think they wanted, which was to stabilise the Queensland market. And it's actually driving house prices and rents up at rates that I don't think we've seen in the last 13 years. Now, this might be short-lived, it might be long-term, but what's important is this demand, if Queensland was already, 100% more expensive than it was, would be one thing, but because we're starting off such a low base, this type of demand would be more like buying Sydney or Melbourne in 2011, knowing that there's a strong second half of the cycle to come. So I'm super excited. I bought 2 properties this year. Simon, you bought 2 this year as well, or one this year, one late last year?
I got one at the start of this year, one in the middle of the year, and I'll probably get another one at the start of next year. Yeah,
we have been extremely aggressive because of our knowledge of cycles and because we are getting this information so early. Like, Phil's updates are literally giving me a window into what's going to happen in a year's time. I've been following the CB updates now for about a year and a half. They are almost an exact view of what's coming 6 months in advance. And the CoreLogic updates are so conservative. I love Tim over there. And he is just so on the pulse in terms of looking at intricate, weird numbers that provide a bit of a guide. Now, we never, ever know what's going to come next. But what I know is that long-term quality properties in quality suburbs at great prices, bought at the right time, do very, very well. And then if you can overlay some of the things that we like to do, which is buying at the bottoms of markets, getting properties either in really good locations and selling them for a profit in 10 years' time, or buying properties in great locations, holding them for the rest of your life and getting great cash flow from them, it is a hell of a time to be an investor. And we're both super excited. But we're not rushing out there and buying 20 properties like a lot of the people you listen to online. Safely buying and setting up one property well a year. And we won't do that forever. We might do that for the next few years, and then we might consolidate for a while and set up for the next thing.
Exactly. It's all about timing, using the cycles to our advantage and trying to buy as close to the bottom as we can to experience the most capital gains that we possibly can. And then it'll be a shift. And we will get to a point where we're talking about it's probably not the right time to be buying property.
Without a doubt.
But that seems like, based off the stuff that we've been hearing from Phil and Catherine and everybody else, like it's going to be quite a while away from now. So super excited.
Yeah, take everything we've said, take everything that CBA says, CoreLogic, Catherine, Phil, SQM, with an absolute grain of salt. We never know what's going to come. We could get a second global outbreak and we could all be stuffed for another year or two. Anything can happen. Like, cycles only work when the majority of people don't understand them. And then once people see the pattern, people start profiting from them. So we hope you can profit from this one. We hope that you ride the wave in Perth or Adelaide or Brisbane or the sunny coast or wherever else it is that you're looking to invest in the next 5 to 6 years. And as always, we wish you all the best.
Thanks so much.
Oh, that's good. That's so nice.